Major support for these programs is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank, Chase Commercial Term Lending, Chelsea Lighting. Additional support is provided by Briarwood Organization, Bruce Mosler, Capital One Bank, CASSIDY TURLEY, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Flushing Bank, Gemini Real Estate Advisors LLC, Genova Burns, Giantomasi and Webster, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, Corman Communities, Madison Realty Capital, Margolin, Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey-Knakal Realty Services, Meridian Capital Group, Newmark Knight Frank, Sterling and Sterling, SJP Properties, Stonehenge Partners, the WITKOFF Group, Urban American, and Ackman Ziff Real Estate, Aerial Property Advisors, Eastern Consolidated, Essex Capital Partners, Goldman Properties, Moynihan Group, Musk Development, RAL Development Services, the Spandrel Group, LLC, Rosewood Realty Group, TERRA CRG, Triangle Equities.
The investment market in the greater New York market is on fire. It is at the highest level I've seen in years. It's happy days again. That's why I got these three brokers over here who are going to talk how much they love the market. But I need a little sanity. I needed to bring somebody, the man who lends money on these deals, to provide their insight. So today, I've really assembled a great group of guys. My guests include Rick Lyon, who's the Executive Vice President in charge of real estate for Capital One Bank, and it is a bank and a credit card company. David Schectman, who is a principal at Eastern Consolidated. Aaron Jungreis, who is the CEO, Grand Pupa, or as he says, the broker at Rosewood Realty. And last but not least, my dear friend, the statistician, the chairman of Massey-Knakal Realty Services, Bob Knakal. No statistics. But are we back to 2007?
You know, Michael, in a lot of ways we are. I think that the vibe of the market, particularly in the last couple of months, has been very reminiscent of what was going on in 2007. I'd say over the past 12 months, cap rates have probably compressed by 200 basis points. And on many of the properties that we have in the market today, we are sending out contracts at or above the asking price. It's getting back to a trading market again, which is just really remarkable.
Mr. Banker, how do you, I mean, it's nice to hear that the world is really doing much better, but I read the Wall Street Journal today and I see that interest rates are going to be maintained. Bernanke wants to keep that. And you know, we're in this island, and it's not only in this island that this real estate is doing well, but it's over there. How do you, you know, as Bob just said, the world is getting better. Is it irrational exuberance over there? How do you see this world?
Well, first of all, I'm very bullish on New York, and I do think we are in an island. It's not this way everywhere in the country, right? So New York, Washington are very unique markets right now. The difference between 2007 and today is actually equity. So people are making their buys, really looking to deploy equity. As an alternative, where else would you put it? I mean, Treasury's at 1.5%. You know, you can look at cap rates at 4%, and that sort of makes sense. What we're worried about is where interest rates will likely go in 3-4 years, and therefore make that play an equity play and try to look at that exit, and we still look at debt yields in the 8-9% range.
Now here's the question. So we have, it's like reform lawyers. They practice law, and then they become investment sales executives. Schectman, over here. Come on, let's talk about it. I mean, how do you see the market? In a number of years, and you're too young anyway, but, how do you look at the market today as opposed to 2009 when you could have gone on food stamps? Or how are you looking at the market by investors? Because what Rick is saying, how many foreign investors, where investors are coming from, who's buying? What are you seeing out there?
Well, first off, thanks for the open-ended question, but I'll be as brief as possible. It's
Wait a second, I haven't let him speak yet.
That's true. It's actually rational exuberance, and I'm glad that Bob and Rick went before me. You have to remember, and at the ripe old age of 37, I have seen some up and down markets, and when I practiced law and was doing workouts, I saw, the bad side of the world. Unlike 05, 06, and 07, the world recognizes that things aren't good outside of New York. And in 05, 6, and 7, folks were calling up Rick and saying, I got this great office tower in Ohio. And Rick, even though his stomach churned, would give them audience. Today, there's very few of those calls, and the people who would have gone to Ohio are coming to New York. The Turkish folks are coming to New York. The Irish, the German, everybody from Vancouver
Wait a
and
second,
India is
the
coming
Irish
here.
have any money after they lost everything before?
We know that people are coming to New York. The world wants to be in New York, in London, perhaps Tokyo, and a sliver in Vancouver. So when you talk about cap rate compression and can it continue, I think it is driven in large part by the debt, and it always will be. But the overwhelming amount of pent-up equity because of the lack of activity and the drop-off in 08 and 09 really are charging the market. For everything that we as brokers bring to market in Manhattan, even if the asking price is slightly out of touch with logic, there are bidders who are willing to take down the deals.
Now, prior to the show, you were talking to me and to Aaron that you had seen, you had an exclusive in Brooklyn. So we're not only in the island of Manhattan, we're in Brooklyn. King of deals under from 1 to 100 million. You're trying to take over for the legend, the legacy man over here, in the bullpen. How do you see? Who's buying? Who's selling? So who's selling? Who's buying? And what
First of all, I want to add to one thing that Rick said about the equity. The banks are also not crazy, not lending 90%. All the deals I'm doing, guys are getting 70, 75% at best.
70 to 75% may be too high.
But the Anglo-Irishes of the world who are giving 90, 95%, they're
That's
not.
why Anglo-Irish is out of business.
You're right.
The Bank
So
of
the
Ireland
banks
is
are
out.
conservative. I'm doing deals in Brooklyn. You mentioned Brooklyn, that people are getting 50% loans. They're very happy putting in 50% cash. These are families, these are very wealthy, well-capitalized families, and they've been sitting on the sidelines and they're doing deals.
Now,
And they're using Capital One, they're using other banks too, but these guys are putting in a lot of cash.
as I remember 2006, 2007, ironically in 2007 I was with an entity and I just read that they just gave back the paper to Citibank yesterday on Savoy, whatever it was called before. But when I read the article, I also noticed that they paid $160 and they got $360 million in financing. So they gave back the property, but they had cashed out maybe $150 million. So here's my question, and it relates to Bob and all of you, and then Rick is the banker, the sane mind to provide something. In 2006, 2007, people wanted to buy a building because it had vacancies, because they could get any potential rent. That was the reason that Stuytown went for such a high number over here. So you were over there. Are people buying these buildings today and want to have the vacancy and they think they can get any rent? How do you see that?
Well, I think that just clearly the dynamic is different. Today, having tenants is a lot more important than not having tenants. But I think one of the most important points about the way the investment sales market is today deals with interest rates, and Rick hit on that point. Interest rates are having two very profound effects on the market. Firstly, for the broader economy, this low interest rate environment we're in is numbing the short-term pain of the massive debt that the country has. And secondly, it's masking the long-term burden of the deficits that we continue to run. For the real estate industry, what it's doing is it's really creating an environment where people, I think, are overpaying for real estate today. And if you look at history, it shows us that low rates for long periods of time create asset bubbles. And when Greenspan kept rates too low in the mid-2000s, it led to the housing bubble. I think you could make a great argument that the same thing is happening today for the commercial real estate industry.
That gives me a little worry. Yes,
Yeah,
disagree.
I disagree with Bob in the sense that people are overpaying. It's incredible. I've actually read some of Bob's studies, and I remember sitting at a presentation in the past year or so where Bob showed, and we talked about cap rate compression. Bob talked about cap rate compression. In the 80s, there was a point at which you were borrowing at 10, 11, 12, 13%. And the cap rates were commensurate with the rates at which you were borrowing. Today, if there's cap rate compression, are people really overpaying if they're buying a 4.1 cap if they're borrowing? And I'm not going to point at Rick, but as representative of some of the banks in the market today, if they're lending at 3.6%, you have positive leverage, even if there's a little dip in the market. You believe that there's potential appreciation. I don't know if that's overpaying
Well,
if you're
David,
fixed to 5 years.
I agree with that point completely. And I think up until now, we've seen a very different dynamic. Even though cap rates are about the same place that they were in 07, in 07 you were borrowing at 5.5 or 6%. Today you're borrowing it in the threes, the mid threes, high threes. The problem is that recently cap rates are dipping below 3.5%. I think we are venturing into negative leverage territory again, which is what is dangerous. If you look over 20 years, when the market gets into a negative leverage position, it's a precursor to a downturn in the market.
And I agree there. I mean, all these points are very valid. The key for us is always looking at the exit and saying, where could interest rates go? I'm happy to let a client take a long-term view, which I think New York is a great long-term view. And particularly if you go into the boroughs and you look at all the multifamily there and so forth, very consistent cash flows, good investment right now. But make sure that's an equity investment and you don't put your buildings at risk by taking 75, 80% leverage today at 3%, 3.5%, and then trying to deal with it 5 years from now at 5.5% or 6% or whatever it could be.
I think many of these people today are not looking at the risk in 5 years. I think when somebody goes to Aaron and Aaron's selling a building and we're having bidding wars today, people are saying, don't worry, 5 years I'm going to be okay. I'm going to get these rents. Look, it's my own colleagues. You know, hey, buy a building over here, the rents are $40, it's $80. Here is my question, and we got to get off the residential. There only X number of people can afford to pay these high rents. You can't, and these high rents are too high. I mean, people are paying at one time, they were paying 30% of their income to live in an apartment. Today they're paying 50% of their income to live in an apartment. It's true that everyone wants to come to New York City, but you know, there's a certain level of what you can expend and where you can live over there. I mean, what's the logic that people say to you or when they buy something?
First of all, I just want to correct one thing. I'm not trying to take over for Mr. Knakal.
Oh, come on.
No one could take over for him.
Great job.
No one could take over for him. He's the benchmark. And he said on CNBC the other week, which I took, he said it's more than double foreign investors that are coming in. A lot of apartment buildings are being occupied by foreigners who can pay the rent, who are taking money out. After this meeting, I have a meeting, after this show, I have a meeting with a guy who is coming from Brazil. He has $100 million, which he referred to the Turkish guy. He wants to spend it there. He wants to get it out. And he's going to come live here. So he's going to take a beautiful apartment and pay $80, $90 a foot.
You haven't answered my question about people looking at the future. I'm going to do two things because then I'm going to go to the office market. What I'm saying to you is this. Today, you can live with this interest rate. None of us have a fortune cookie to figure out the number, but rates have never been this number. In 5 years, if rates are 7 to 8% and the rents haven't gone up high enough, we're going to have another situation of 2007 where we're going to have people saying, oh, I had that thing, I was going to rent it. And then there's a blip. We're going to have that problem again. And the banks who are making these risks, okay, and some of them are doing 10 years money and they're keeping it on their balance sheet, and we understand that.
Michael, though, it's not the rents. The fundamentals have been performing pretty well. We have a number of clients, all three of us, that have worked very hard to get top-line revenue up 15 to 20% over the last 2 or 3 years. The problem is net incomes are flat because real estate taxes.
Thank you. I was
And water and sewer
okay,
also.
I was
went
going
up
to
again.
say
That's the other big
the
risk.
key. Your real estate
Stagflation.
taxes are going up completely. Your water and sewer. Then there's deferred maintenance because a lot of these buildings that all of you are selling or he's financing are old. Okay, you know, I pass buildings in my neighborhood and I say, thank God my building doesn't have a terrace, because I see all these buildings where the terraces now have to be improved.
Right.
So the expense over there, and then there's local law 11, there's local law 9, there's local law everything. Let's get to the office market. As I said the other day, and Bob was there when I was moderating a panel, people are leasing space. They're renewing space. They're renewing space at rents which are not at the level. We are not at 2007, 2008 office rents. You can get a rent. One of our mutual friends in the banking market is talking about taking substantial space either in the building that is existing or another Park Avenue building, and he's talking about $70 a square foot. We were at $100 a foot. We were $110 a foot. The office market hasn't improved, has it?
Well, I don't think the office market's. Again, New York is unique. The office vacancy has really improved. So occupancy's up. We are seeing deals done. The key is that the office market. There's no impetus for clients to actually want to pay more. You're not seeing top line growth in and business expansion.
We
So
also have. Let's also be realistic. Now, it's nice that you sold recently a site on 48th Street, in other markets. We have Hudson Yards. We have a lot of office space going on market over there. Within that marketplace, you have related Onyx over on Hudson Yards. You have Brookfield. You have Gary Barnett. So you have 3 buildings. You have Boston Properties deals on 55th Street. The Trade Center, I don't have to talk to you how many buildings are coming up over there. So, you have a lot of office space, and we don't have that many companies. There are a lot of tech companies coming in, but it's not, the office market isn't improving that well.
I'm looking at space. I'm sorry. I'm looking for space now, and it's cheaper. I'm looking to expand. And where I'm going, it's about 10 to 12% cheaper than when it was when I signed my lease.
And when did you sign your lease?
07.
So you're saying that in 07, the rents
End
were,
of-
were going higher.
Yeah.
So
But Michael, the market needs new office product. I mean, you walk down the street
I'm
here.
not
Thank you.
questioning
The
the
30-year-old building is a new building here.
I'm not
in town.
questioning the need, but, but part of the situation relates to taxes. We have all this Class B space in Lower Manhattan, and in 1990s, when they created the 421Gs, which were a full tax abatement, that was the way these buildings were maintained. Because a person like Rock Rose or like Joe Moynihan or a number of other people, Larry Gluck, bought buildings over there, and they were able to go into this property, and they were able to get no taxes for 15 years. Unless there is some type of incentive for the 421Gs or some type of program for full tax abatement, you're going to have these office buildings in Lower Manhattan with nobody moving in there. They're inefficient and everything. So you need the conversion over there, and you need the apartment space. How do you look at, the boroughs of Brooklyn, the borough of Queens? I had this panel the other day, and I had mentioned, South Ozone Park. I mean, we laughed about it, but, the Racino at Aqueduct had the highest revenue of any slot operation in the country the last couple months. So people are coming over here. How do you see the boroughs today? What's happening with investment sales in the boroughs with regard to retail, with regard to residential? How do you see that, Aaron?
Residential's on fire.
Other asset classes.
Brooklyn is crazy for residential. Queens is still very strong, and even the Bronx is still staying strong. It hasn't gone up, but it's very strong.
There is a 5th borough. I think they call it Staten Island. What about that?
I don't know.
But there's activity in Staten Island. Let's go back to what you were saying about the other food groups, though, in the boroughs. And we're heavier in retail and some office and mixed product and development, very development heavy in the boroughs. Dispensing with the brokerage embellishment for the audience today, it really is white hot. You can't keep product on the shelf in the boroughs, and there's a real desire. And the first time that I've been in the business, which is either as a lawyer or as a broker, there are people from outside of New York recognizing the value of Brooklyn and Queens for purposes other than bedroom communities with mom and pop retail. There are people looking up. They're looking past the first floor. We've had big box in the boroughs for years, but now we're starting to see on the second and third floors. And I think that we all owe Marty Markowitz and other politicians who comedic value aside, have done a tremendous job of waking up the world to the boroughs. Brooklyn is what? The nation's second largest city. It really has tremendous value, and people recognize it.
Now, but here, okay, so we're talking that Brooklyn is fine. We're talking that Queens is activity, the Bronx some activity, Staten Island limited activity. You live in Westchester.
Right.
You live in Long Island. How's the investment sales market in those places?
What investment sales market?
Yeah.
But you know what they do in Westchester and Bergen County, in Dutchess and Ulster, and in states outside of New York? Amazingly, outside of city centers, all of these counties have found brilliant and much quicker ways to incentivize industry and commerce to stay in those counties. When we talk about millions of square feet coming online in both the Hudson Yards and the World Financial Center downtown, I think it is...
You don't want to talk about Stanford. There's plenty of vacancy in Stanford, and it's taking a little while longer.
There certainly is, but we are on the island of Manhattan, and at the risk of sounding New York-centric...
But I just heard from what you said that there is no investment sales market in Westchester. Is there an investment sales market in Nassau or Suffolk?
Very light. There is, but it's light.
Rob?
Well, we see the boroughs mainly. We do most of our work in the boroughs. Once you get outside into Nassau,
Now, one time you had a New
tough.
Jersey office. Do you see any? And Rick, handles the entire country for real estate. So he sees a variety of things. How do you see? And I'm not planning the same question I used a couple of years ago. Are there any markets besides Hoboken and Jersey City, who many people consider the 6th and 7th borough? Are there any markets that are really doing well that you would lend to, that you would feel comfortable, that you've seen deals in New Jersey today?
We have a very good business in New Jersey, and again, it's picking the right folks, stable,
the right horse, baby.
Right. Always, that's always our motto. And then we look at the market and the building, and we look at the risk that building is going to have, and we don't trend. I mean, we don't trend in New York. We're certainly not trending in New Jersey on any rents, and we take a conservative position in those. But there are some fine properties. I mean, Morristown is a stable market. We're looking at a hotel there, and it's been there forever, and looks like a very nice at the right leverage point. But you
bring up a good point to go on a different market. When we were talking about the food classes, the different fruits of the vine that we can have in the market, one market that has really started to turn the earliest was the hospitality market. Are you seeing a number of development sites in New York City, in the city? Let's not only talk about Manhattan, being sold or being on the market for hospitality today?
Yeah, absolutely. And in fact, the prices per square foot are well above where they were at the peak in 2007, well above. And that's a function of how strong that market is. We lost about 10,000 hotel rooms.
Yeah, but that 10,000 rooms, I mean, we've improved that. We've increased that by 25,000. So the 10,000 has gone up to 25,000. And
but still, try to get a hotel.
Yeah, I was going to say, try to get a hotel room in New York City
today.
In New York City or Manhattan?
Manhattan. Yeah,
Now,
I mean,
so let's be realistic. You go into Long Island City, there are 27 hotels in Long Island City. Do you think somebody who's traveling from London says, I want to be on Astoria Boulevard or Steinway Street in Long Island City?
They may have no choice, Michael. They may have no choice.
Thank
50 million people a year come here. Where are they going to go?
Statistician, let's do it correct. It's 50 and a half million.
I didn't want to be too specific. I didn't want to get some brief from you.
We have airports outside of Manhattan. We have people who actually do have business needs. I'm a native Brooklynite. I take umbrage. Yes, there are people who come from other countries who want and need.
Now let's understand the
to be in
hotels-
Brooklyn.
Now the hotels in Brooklyn when I was growing up, they had other purposes.
They were
okay?
pay to stay.
They,
Pay to
they,
stay.
they were
Hot
different. They were called hot sheet hotels. But what I'm saying to you, I still remember financing one of them near LaGuardia Airport. The guy happened to be the chairman of Metro Media Radio. I said, "What's your occupancy?" He says, "155% before 6." So the question is, the hospitality market is also on fire. Now, there's another aspect in this world. Do you see anything with regard to other alternatives? How's the industrial market? Is there an industrial market to speak of?
In Bush Terminal, Industry City,
So it's limited.
some parts of Long Island City, very limited.
Let's come
In
back
fact-
in New Jersey. That's a decent market in New Jersey. Exit 8, 7A, 9. So that's a decent market.
And what about let's say some specialty markets? Let's talk about I remember I had your colleague Ben Stacks a number of months ago on the show, on a retail show, and we were talking about the specialized health clubs. There's one, these unique like lifestyle health clubs. Do you see that happening today in the boroughs? Are properties being sold and developed for health clubs and other accessories?
I don't think as much on the boroughs, but there are a number of brands in the market that initially
Right, the
came in.
Blink now, you have some
And
other...
every day there's a newfangled brand, and a lot of them are credible and they have equity. They're tougher to find product for because they're specific.
And they're definitely tough that he won't finance. I mean,
All about the sponsor on that one.
It's all the sponsor. As Bob eloquently said, we have 50.5 million visitors over here. Another market that's doing well is the restaurant market. Are you seeing any properties being sold to franchisees or to restaurant people?
Yeah, absolutely. Restaurants typically can afford to pay higher rents and therefore higher prices for properties. So whenever we sell a property that has a vacant ground floor, restaurant users are always very interested in those
With like
buildings.
30 seconds left, what's the most expensive location today in Manhattan, for any asset that's being sold today? What do you
The
see?
Fifth Avenue in the 50s. I think everybody was blown away by $8,300 a square foot at 666. I think we could easily see trades in the $20,000 to $25,000 a foot range
for the
within
retail.
next year.
Okay, Aaron, quick.
I agree.
I think that's right, but I think we got to keep our eyes on Soho. I think Soho is just astonishing at the moment, and we're selling at $3,000, $4,000, and $5,000 a foot.
I think I've had a great group of guys. I hope to see you in the 12th season. When we come back in September, I'd like to thank Rick Lyons, David Schectman, Aaron Jungreis, and Bob Knakal. See you next week.